starting. All attendees are in listen-only mode.
Good evening, everyone. Welcome to Admiral Markets webinar, 10th of April 2014. Today we had a great day trading euro dollar. As you can see, we made nice profits. And now we need to explain how markets does and how actually we make profits out of the market. So today's webinar will be about understanding market structure, understanding market movements, or about players, traders in Forex market, and actually how market structure works. So you need to know about that. It's not only about systems, it's not only about economical fundamental releases. You need to know how market structure works, how Forex works generally. Before we begin with our presentation, as always, our risk disclaimer: online educational materials are developed by Admiral Markets AS Estonia for a global audience. Therefore, please take into consideration that information in this session may not be suitable for everyone. To get the corresponding information on charting conditions and any other detail, please visit www.admiralmarketsglobal.com, select your country of residence, contact an appropriate entity. Risk disclaimer explaining all the risks associated with Forex market. By proceeding further, you are also accepting all the risks associated with it. Final part: Admiral Markets UK Ltd takes no responsibility for the information accuracy. The analysis represents the personal opinion of the authors, me and Chris, and in no way it represents the actual suggestion for the trade. These are not UK's opinions, and the website in the video is not .co.uk website but the globalnews.com website. Forex is risky business. This is personal opinion only. This webinar is for informational and educational purposes only. So today, Mr. Chris Warsick is also with me. He will be presenting his part of the webinar as soon as I finish. So, today, I'm going to talk about characteristics of Forex market, main players in Forex market, biggest Forex traders, then what determines exchange rate and Forex market structure. So, you know that characteristics of Forex market are basically, you know about that. We talked about that. We won't mention it now far and wide. So need to tell you that Forex market has a very high liquidity. Daily turnover is over $5 billion US. Wall Street daily turnover is 75 billion average. So Forex market is really big. I always compare it to a fast-paced marathon. Basically, we are the runners, long-distance runners, and we try to be as long as we can in this lane. So Forex is very decentralized. It doesn't have any centralized structure compared to stock exchange. So basically, many factors determine exchange rates. So many factors determine exchange rates. It's not just traders. It's not just speculators. We will see there are many factors which move the market, and because of that, it's not decentralized. It doesn't have any centralized unit as stock exchange. Basically, many factors influence Forex market. It's open to retail traders 24/5, Monday till Friday. Usually, one of the biggest advantages of Admiral Markets platform is really platform time is Eastern European. So basically, it's GMT +3. When we have GMT shift, then it's GMT +2, and that is great thing because candle closes on Admiral Markets are the most accurate. And that is the big change that I welcome. Whoever made that in Admiral Markets, I don't know who made it and who brought the change. That change is perfect, if you ask me, because lately, we didn't notice, and we don't notice those false gaps which can represent on Sunday candle. And basically, this is a little digression from our main subject. Basically, if you trade with Admiral Markets platform, you will have the same close as New York traders. Okay, I got the message that my screen is frozen. How? Do you all see characteristics of Forex market slide? Okay, yeah, thank you. Now it's not frozen. Great. So the biggest advantage is you will have this. We will all have now, and we are having the same close as New York traders do. So basically, those candles are very, very valid because New York traders and those who trade also across the border will have the same candle closes as we do, and basically there is no Sunday false candle. So it's a very, very welcome change, and that is also very important when I speak about Forex market being open 24/5. It's a very, very good change because when Forex market opens on Monday and we have a really great overview of the whole week without that false candle which forms on Sundays. So I really welcome that change. Forex is generally interbank market is open 24/7, and usually when you type, you can type www I don't know, xset.com. Usually you will have all they follow that interbank market, and then they give you the exchange rates which are valid also through Sunday and Saturday. So basically, I usually, let's say that I have a trade opened during the weekend, and I would like to see where the price is going or where is any movement of the price. I usually visit www.xe.com and I see the real-time movement of the price. So I just use that site for giving me information about Saturday and Sunday movements, nothing else. It's only if I have a trade open during the weekend, which is very, very rare. Maybe once in I don't know, 3 or 5 months, something is open during the weekend, but it's very rare, really. In April 2013, for the first time, Singapore surpassed Japan in average daily forex exchange trading volume. So basically, the rank now is United Kingdom 41%, United States 90%, Singapore 5.7, Japan 5.6, and Hong Kong 4.1. So basically, that is the average percent of the whole turnover in Forex markets. So you can see that United Kingdom, London market, has the greatest trading volume in Forex market. Then there goes United States, Singapore, Japan, and Hong Kong. Trading, as we can see, it's 24/5. I say for us retail traders, 24/5, 5 days in week, excellent, because we need Saturday, Sunday to relax. And even though if it would be possible someday to trade a Saturday, Sunday, I wouldn't do it because we need the time to rest. Now, who are the main players in Forex market? Those are countries, central banks, companies, foreign exchange fixing, speculants, investment management firms, non-bank foreign exchange companies, and money transfer remittance companies and bureau de change. Okay, I will talk about it. Countries move the Forex market through borrowing and bond issue, even though if you're not economically if you don't have any economical knowledge, you know that countries do borrow the money, the central banks sell and issue bonds, and they also, countries are issuing bonds. So basically, countries also, states and countries, move the market. National central banks, they are very important in foreign exchange markets, basically because they try to control the money supply, inflation, interest rates, and usually they have official or unofficial target rates for their currencies. So bear in mind that central banks often have official or unofficial target rates for their currencies. So they use their own substantial foreign exchange reserves to stabilize the market. And the effectiveness of central bank stabilizing speculation is very doubtful, because central banks cannot go bankrupt if they make large losses like other traders. So there is no convincing evidence they do really make a profit trading. So that is really, you know, it's some sort of a paradox, because really central banks cannot go bankrupt. That's the truth. Commercial banks also, I just mentioned here central banks, but I also need to tell you about commercial banks through foreign exchange, to fixing foreign exchange courses through central bank. They also do some foreign exchange movement. Usually commercial banks, you know, you pay through banks, you also exchange money in your bank, so basically they are all player in Forex market. Commercial companies also, they trade fairly small amounts compared to those of banks or speculators, but trade flows which go through commercial companies are a very important factor in the long-term direction of a particular currency exchange rate. And basically some multinational companies usually can have unpredictable impact when very large positions are covered due to those exposures that are not widely known by other market participants. So commercial companies also influence Forex market. Then we have basically foreign exchange fixing. What is foreign exchange fixing? It is, how can I explain that best to say, daily. It's a daily monetary exchange rate which is fixed by the national bank of each country. And the idea behind foreign exchange fixing is that central banks use the fixing time and exchange rate to evaluate behavior of their currency. So fixing exchange rates reflects the real value of equilibrium in the market. And banks, dealers, and traders use fixing rates as a trend indicator. So basically, foreign exchange fixing is also a big thing in Forex trading. Speculants, you know, speculants, we are also speculators as retail traders, and also we go in that speculation a little bit behind, because I will say that brokers and dealers are also speculants. We call it sometimes market makers. Brokers serve as an intermediate agent of the customer in Forex market by seeking the best price in the market for retails. They charge, of course, commissions or markup. We call that commission or markup, in addition to the price obtained in the market. Dealers or market makers, they usually serve as principal in the transaction versus the retail customer, and they quote a price they're willing to deal at. So, you know, today a number of foreign exchange brokers operate directly from the UK under Financial Service Authority, FCA, FSA, former FSA, today FCA, or Financial Central Authority, where Forex exchange trading is part of over-the-counter trading. So that is also a part of CFD, contract for difference, and financial spread betting. Then we also have investment management firms. Investment management firms usually manage large accounts. You know, I have worked for an investment management firm. They usually manage large accounts on behalf of customers. Let's say they're trading hedge funds, pension funds, endowments, and they use the foreign exchange market to facilitate transaction in foreign securities. They also, of course, move the market. They have a big money pool, so they can move the market. And what I can say about money transfer remittance companies and bureau de change, or bureau of exchange, that is a French word, bureau de change. In English, it's bureau of changes. How can I translate it from France? Something like that. It sounds like that. So basically, what is this? That, in my opinion, that is, and I generally think, as far as I remember, the currency transfer companies which provide low-value foreign exchange services for travelers. That is bureau de change. Those are typical small companies which are located at airports and stations. and usually they can be found also at various tourist locations, and they allow physical notes to be exchanged from one currency to another. So basically they access the foreign exchange markets by banks or non-bank foreign exchange companies. So that is bureau de change or money transfer remittance companies, such as, let's say, Western Union. They also move the markets. Western Union, also Skrill, PayPal, or those other money transfer or remittance companies. Now, biggest forex traders as of May of 2014, you can see it. Those are data from 2013, and they are valid. Deutsche Bank, of course, 15.18%. Citibank, American Bank, 14.90%. You can see the table here. And UBS Bank is in 4th place. You can see Swiss Bank. So basically, you can see all of those big banks, which are the biggest forex traders of May 2013, and Deutsche Bank. Really, well, we all know what Deutsche Bank is. It's a giant. It's really a giant in forex market change. Also, you can see at the bottom, but it's still a big. It's 3% of overall volume. It's Bank of America, Merrill Lynch, which also has its fund, pension fund, Merrill Lynch. Then there is the Royal Bank of Scotland, Credit Suisse Bank, HSBC. So many of those banks you have probably heard of, and they're really the main market movers of all commercial banks as of May 2013. But the same is for today. I don't count, of course, those are commercial banks. I don't count central banks such as ECB, Fed, RBI, Bank of Japan, central banks. Really, they are also, of course, central banks. But commercial banks are also very, very important players, because they follow through the policy of central banks. They are following the policy of central banks, and they really move the market. Now, what determines exchange rates? What determines exchange rates? I can say these factors determine exchange rates. Those are economic policy, government budget deficits or surpluses, balance of trade levels and trends, inflation levels and trends, economic growth and health, political conditions, and market psychology. Economic policy, of course, it comprises a government fiscal policy, and fiscal policy is budget and spending practices, and monetary policy. Monetary policy is the mean by which a government central bank influences the supply and cost of money, which is reflected by the level of interest rates. So basically the biggest thing in economic policy is that reflection of interest rates. You know, usually when interest rates is about to happen, market gets very, very volatile. And I usually, in the analysis that I make for that particular day, I always state, watch out, because there will be interest rate decision, so be very careful. Then we have government budget deficit or surpluses. Basically, the market usually reacts negatively to widening government budget deficits, and there is usually a positive reaction if there is a narrowing of budget deficits. The impact of that policy is reflected in the value of a country's currency. So the value of a country's currency is reflected through government budget deficits or surpluses. Then we have balance of trade levels and trends. The trade flow between countries, usually it is the trend, it is usually the demand for goods and services, and that is an indicator of, how can I say, of a demand for a country's currency to conduct a trade. Surpluses and deficits usually reflect the competition, I can say, and competitiveness of a nation's economy. And usually trade deficits have a very negative impact on a nation's currency. So if there is a trade deficit, that currency, of course, is usually shorted versus US dollar. Then we have inflation levels and trends. Typically, a currency will lose value if there is a high level of inflation. Why? Because, you know, from economic part, even if you are not an economist, you know that basically inflation kills purchasing power, right? Inflation kills purchasing power, and in turn, it kills also a demand for that particular currency. So if inflation level is too big, it's not good. Also, deflation is not too big, because if deflation happens, usually central bank needs to devalue currency, its own national currency. That happened with yen. Then there is economic growth and health. Basically, reports such as GDP, employment levels, retail sales, capacity utilization, they usually give the details of a country's economic growth and health. Then there is, of course, political conditions and market psychology. You know that all exchange rates are susceptible to political instability and anticipations about the new ruling party. If that happens, usually market will wait for a particular development, and market will wait for that to, let's say that market is waiting for something. And usually when we see that price is ranging. Usually euro dollar as the most traded currency pair is ranging, and you can see that basically market is waiting for something. Let's say that if a country is experiencing financial difficulties, usually the rise of a political faction that is perceived to be fiscally responsible, it can have a positive effect. So negative effect usually goes if there is a destabilization of coalition governments. Then we have a market psychology. You know what market psychology is, we talked about it. Basically, it's long-term trend, it's buy the rumor, sell the fact, economic numbers, technical trading. And technical trading thing, I need to add that basically it's also in other markets. The accumulated price, let's say, in a currency pair such as euro-dollar can form apparent patterns, and those patterns we trade. So that is why I always say trade not just euro-dollar. Basically, if you study price charts, if you can identify patterns, if you can identify support and resistance levels, you can always trade 23, 24 pairs, not just euro-dollar. There also, you know, I usually write buy the rumor, sell the fact in my response to traders questions and answers on usually on Forex Factory Spiders Den. Buy the rumor, sell the fact is a well-known quote, and basically it is the tendency for the price of a currency to reflect the impact of a particular action but before it occurs. And when the anticipated event comes to pass, it reacts in exactly the opposite direction. So that we can say oversold and overbought, you know, oversold and overbought. Also, you know, long-term trends. Usually market cycles make those long-term trends. Basic cycles make also, and usually long-term trends impact also exchange rates. Then this is how Forex market structure works. Basically, this is how how we trade. So there is at the one side there are retail traders which go through online Forex market makers. It's online trading. They go through banks, and banks go through EBS and Reuters. We can say that we retail traders use online Forex market makers or brokers to go to interbank market. Our brokers are connected to well-known names: Deutsche Bank, UBS, Citibank, HSBC. So each bank is structured differently, but most banks will usually have a separate group known as the Foreign Exchange Sales and Trading Department that has every single bank which trades in interbank market. That group is responsible usually for making prices for the bank's clients and for setting that risk with other banks. Usually within the foreign exchange group there is sales and a trading desk. The sales desk generally is responsible for taking the orders from the client, getting a quote from the spot trader, and relaying the quote to the client to see if they want to deal on it. Usually that three-step process is quite common because even in online foreign exchange trading, many of large clients who deal anywhere from billions of dollars in time, they believe that they can get better pricing over the phone than over the trading platform. So still that trading over the phone exists, but we are interested mostly in trading through platform, of course. Then there is a foreign exchange spot trading desk, and usually there are one or two market makers which are responsible for each currency pair. So let's say that we trade euro dollar, and there is only one primary dealer that will give quotes on the currency. So basically there is a primary dealer. Then there is a secondary dealer that gives quotes on a smaller transaction size. Why is that important? Because banks they want to be sure that each dealer knows its currency well and understands the behavior of other players in the market. Then basically we can say that if we talk about banks, because we go through brokers and brokers are connected to banks, how do those banks determine the price? Well, bank dealers will determine prices based upon many factors. So the current market rate, how much volume is available, then there is their views on where the currency pair is headed. If they think that euro is going to be higher, they may be willing to offer a more competitive rate for clients who want to sell euros because they believe that once they are given the euros, they can hold on to them for a few pips and offset for a better price. So basically, they do very often those risking offset. They basically not risking offset, offsetting the risk. It's called offsetting the risk. So let's say that they think that euro will go lower, and usually if the client is giving them euros, they may offer a lower price because they're not sure if they can sell euro back to the market at the same level at which it was given to them. And that is very unique to market makers that do not offer a fixed spread. As I said, usually banks do that by offsetting the risk. And basically, how do they do that? As you can see, banks go through EBS and Reuters. Platforms which interbank traders use are Reuters Dealing, and other is Electronic Brokerage Service, EBS. Interbank market is a credit-approved system, and banks trade based solely on the credit relationships they have established with one another. So all of the banks can see the best market rates which are available, but each bank must have a specific target relationship with another bank in order to trade at the rates which are being offered. Now, the bigger the banks, the more credit relationships they can have, and the better pricing there will be an access. So both EBS and Reuters dealing system offer trading in the major currency pairs, but certain currency pairs are more liquid and traded more frequently in one or another platform. And this is the breakdown where each currency pair is primarily traded. On EBS, euro, dollar yen, euro Swiss, dollar Swiss. On Reuters, cable, euro, GBP, dollar CAD, dollar, Australian dollar, and New Zealand dollar. So basically that is the breakdown where each currency pair is primarily traded. Now, we need to say also that cross-currency pairs, they are not quoted on either platform, but they are calculated based on the rates of the major currency pairs, and then they are offset. We will talk about it when we and Chris, we are going to have a special webinar in May. We will talk about why you should trade more currency pairs, not just one, and we will mention how those cross-currency pairs are traded and how they are basically quoted. So basically, the thing which I can say for Forex market structure that we retail traders, we are really we rely on online market makers, online brokers. So Forex brokers use their own capital to gain credit with the banks that trade on the interbank market. So if we go through brokers, and we do, Forex brokers use their own capital to gain credit with the banks that trade on the interbank market. The more well capitalized the broker is, the more credit relationship it can establish, and it can give us further the more competitive pricing. And that is the big thing in Forex trading, because if we have good spreads, we can trade 23, 24 pairs. If a broker does not offer very good spreads to that relations, we cannot do that. So brokers, remember this, brokers use their own capital to gain credit with the banks that trade in interbank Forex market. Now, if a Forex broker is not capitalized enough, they cannot access to a more competitive pricing than a broker which is well capitalized. So it's very important for us individual traders and individual investors to do that search for the Forex broker which we will choose to trade. That is why, of course, we trade through Admiral Markets. We have great spreads, we have excellent quotes, and because of that also do not trade just 3 or 4 pairs. Guys, concentrate more on those minor crosses. In the next webinar in May, we will explain why you should trade also other pairs, and why you can make a diversification, because not each currency pair can be traded each day. There are pairs which can be traded in Asia session, in whole day, in just London session, and usually if you see that euro dollar or cable is ranging, why not switch to euro CAD, or switch to Australian dollar, New Zealand dollar. Believe me, it's great and it's working fine. So guys, this is what I wanted to say. Now I will hand over the presentation to Chris, and I think that now you have that good understanding of how Forex market structure is working. So Chris, you can continue with your part of presentation.
Yep. Thank you so much, T.
No worries.
Alrighty, 1 second, folks, as I set up the charts, or not the charts, I mean the presentation here. Good. So let me just see if you could see my screen. Yes, you can. Goody good. Great. So we had a great explanation from Tarantula regarding the market structure, how basically the banks are in part, and all the market participants are basically involved in Forex. I will be taking a look at a different point of view, or not a point of view, but a different angle, kind of. I totally agree with Tarantula. It's just what I meant more is a different angle. Market structure, I wanted to talk more about basically the price structure, maybe would have been a more correct word for what I'm going to show you. In fact, because what Tarantula was showing is indeed like the market itself. What I want to show more is regarding price. How is price actually moving? What are the factors that could be influencing a price and its movements in this regard? Okay, so a bit different shift, a bit different emphasis on a slightly different topic. Okay, in my opinion, when looking at the structure of price and its movements on the charts, basically, I think that the following things that you see here on the slide define why price is moving as it is. Okay, many traders do like to complain, especially, of course, if the trade doesn't go our way, that for whatever reason it's not going our way, and complain about that. I think that eventually, once you gain more and more experience, you will get rid of that, because it's a bit self-defeating. It's just getting you in a negative vibe And that's just the way things go. It's just, it has its ups and downs, basically. It has its legs, it has its swings, it has its moods, if you like, and that's something we have to just live with. But we do, and we can try to best interpret the movements when looking at the charts and making our best estimates and best analysis, or at least trying to make analysis that allows us to capitalize on the movements. That's basically the goal, isn't it? Right? That we have a system expectancy of our strategy that is positive. So one of the ways to do that is to understand how the market respects, what the price basically respects. Now, you see here, this is how it moves. It moves basically from support and resistances. It respects, it goes in impulses and corrections, or momentum and consolidations. It has trends, reversals, and ranges. And some even like to use wave structures to understand what's going on. All right. Now, the last point is not maybe the most popular, or at least it's popular with a group of traders, but maybe not very widespread. It depends, I guess, who you ask. It's very well known. It's a bit more difficult to understand. So that depends on your own take of things. But the first three things, I would say, is something universal. It's something that everyone agrees upon, that this is more or less vital. Now, not everyone uses necessarily impulse or correction for their own trading purposes, right? But it does define the market, just like waves do. But then again, once again, not everyone uses it. There's a difference, of course, but this is basically the underpinning of the market, right? Market stops at support, stops at resistances. The impulse stops there. Corrections maybe start again at support after corrections have ended. We have trends, reversals, and ranges. The market does not move any other way. It always is moving in a trend, reversal, or range. There's no other body or way to explain it. It always moves in impulse or correction, right? Price respects, or actually not necessarily always respects, but we should expect it to respect support and resistances, various ones. Price is always moving in ups and downs, swing highs and swing lows, with the various degrees and moving basically up and down. And these patterns repeat themselves on various time frames. That's also a characteristic. All these patterns repeat themselves. And it does so in waves. Now, whether you want to look at it or not, but they do happen like that. They have these wave characteristics. Right? Now, we use tools and indicators for identifying all these stages what the currency is in. That's why we use these to help us support the analysis of understanding the market structure. And when we understand that, the price structure, then we're trying to analyze where we like to trade most. And if you look at the trading room, the live trading room that we have once in a while, you'll see me often talk about where potential spaces that could be interesting to trade, which levels would need to be broken, which indicators would need to show something before that particular space becomes interesting to trade. What am I looking for to trade? And by doing that, by setting up certain levels, certain areas, certain things that need to be done, you're trying to remove the bias, and you're trying to let the market decide what it wants. You want to follow price, react to what it's doing, not to predict it. As I said this morning, we're not here to be fortune tellers. We're not here to be saying, okay, the odd USD is going to be at 95 by next week, Wednesday, or 97 by 2 weeks from now. No, that's not our task. Doesn't really matter. So we're there to react to the market upon our strategy, not to predict. You can do that. How can you react? By using these tools and indicators to decipher the information and communication that price is giving to us. And price is always speaking to us. It's always speaking a certain language for us to interpret it as good as we can and as fluently as we can. And just as learning foreign languages, basically, and the more we practice it, the better we get. The same we can say for the market and price. So let's take a look at those things on this chart. What is price doing here? It's trending, isn't it? Where are the impulses? Well, the impulses are here. Where are the corrections? Here. Where are the impulses? Here. Corrections. What are the chart patterns? So that's impulse, correction, trends, right? We're in a trend. What else were we looking at? Support and resistance. Maybe here, you don't see it here, but maybe there was a support here, and that's why it bounced off. Maybe here there was some resistance. That's why it stopped there. Wave structure. We don't know exactly at the moment because it's maybe too little information. But this definitely looks like a potential wave 1 or 3, very impulsive, right? This could be wave 4, could be like a 1, 2, 3, 4, and extended 5. You get the point. So basically, at its core, for whatever reason, why it does what it does what it does. So although it's interesting to look at why, it just moves there. It just goes from level to level in these patterns, and these patterns repeat on all time frames. Now, certain time frames might have certain characteristics that are unique. It's possible, but in general, these patterns, roughly speaking, do repeat themselves on all time frames. It's just, of course, that these patterns take longer to unfold on higher time frames logically, right? That just goes without saying. The price is moving from level to level, and it does so with basically what we just said, right? It goes from level to level in patterns using these 4 items. Okay, that's the summary. Now let's talk about maybe why it could be moving like that. Why does it move like that? Basically, it's influenced by the sum aggregate of market participants. Now we know that certain market participants have more voting skills here or more voting weight because of their money talks. Let me say it this way: the amount of currency they handle is going to give them more influence or more impact, most likely. So in any case, it's the sum aggregate of market participants, right? It's the market movements is dictated by its participants, right? Someone who's not participating is not going to have any influence on it, logically. Well, not necessarily. We could have some press conferences, but by key figures in central banks, but central bank itself is a participant as well, so it is actually a participant. But that's the reason, right? But basically, prices moved by the big boys, right, as Dante says. But then again, why worry? To come back to the point again, why worry about that? In fact, why worry about why is it and what can we influence it? Why worry about that? Because the fact that there is this market gives us the opportunity to actually capitalize on these opportunities. It's a good thing. It's a good thing there are big moves. It's a good thing that the market is moving. If the market is flat, there's no opportunity. So I wouldn't be stressing or worrying about the fact that the market is maybe moving and being influenced by market participants and the fact how it's done. It's good to know it, but then again, it just moves because it moves. It's just moving as is. So why not just focus on capitalizing on it? And of course, in that regard, in my opinion, price is moving according to the path of least resistance. Now, this is something that is maybe a bit of a bias, but this is my opinion. Price is going to move at certain times where there's least resistance. Let's talk about that a bit more. Here is an example of what I wanted to discuss regarding least resistance. We have here various things on the dotted cat indicating a potential end of this downside. We have a falling wedge, we have divergence, we have -618 target, we have a bigger uptrend. So the path of least resistance at that point meant that the downside was over and upside received the favor. At any point in time, at any point when you're looking at a chart, there's going to be a path of least resistance. Although we might have a long-term trend, doesn't mean that the price is going to move up right now, because on the smaller time frame, there could be a small resistance or a small overbought level and then no one wants to buy at that point. So the path of least resistance is down at that point on the 5-minute chart, even though the 4-hour trend could be up. Because at that particular time frame, the path of least resistance is down. So it makes that downside. What happens after that downside? Well, the path of least resistance is up because the hourly and 4-hour trend is up. So buyers step in because they're getting a discount. So what is the path of least resistance at that point? Is up. And all this decision tree path, right, basically has its ups and downs. We're at point A. The path of least resistance at a certain point when price is going up is going to bump into resistance. 23 pips up on the 5-minute chart, usually you see some retracement. So you get the retracement. It's actually the other way around. Up, you get the retracement. That's the path of least resistance at that point. But we're in an intraday uptrend. So we see buyers step in again. Path of least resistance is again up. But we break the top by a few pips. Again, resistance. Right? This is the path of least resistance. So when you're here, at this point, although, of course, there could be various paths of least resistances that might be equally probable, there are a couple that seem more likely at any point, basically. At this green level, you could maybe already, as for those in the live trading room, you see me already sometimes draw these things. Based on divergence and trend, you can say, you already see me sketch out one particular path of least resistance that to me seems the most likely. That's based on this theory, right? This could be probable, but the problem is that the further you go into the future, of course, the less chance that this will happen, right? The chance that this could happen, let's say, up to the orange line is statistically a lot higher, right? That the path of least resistance analysis is more likely than the next orange line because it's more in the future. And as we go into the future and we get closer to the orange lines, right, the green line moves forward and we go into the future, we get more info and therefore we can adjust this path of least resistance. And we then reconfigure what the expectancy is of the orange according to the market structure. Let's say in this example that we went up, but not as much as up as we thought, and we already got a bigger retracement. Well, then the expectancy of price at orange is going to be different than at the first green, right? It's going to be different at the green arrow than at the blue arrow, and that's how we move along, and that's how we continuously analyze the charts to seek and identify the best opportunities now or in the near future. And that's why, although we can make a path of least resistance to a certain point, it doesn't make sense to do it too far because it's not relevant. Also, it doesn't make sense, therefore, to predict what a price will be at on the audio 097 in 5 days from now. That's really not too relevant because we're looking for trading opportunities within this path of least resistance, not for knowing the end point of the path of least resistance at one particular spot. It's not relevant, right? What we're looking for when you have this path of least resistance is where do we want to trade it, but not what is price going to be at point red and what is the level exactly. So that is why the path of least resistance is useful, but only for trading purposes, not to predict. And we come back to the fact that prediction is not really relevant. Unless you're making a friendly bet with your neighbor, that's something else. So path of least resistance, basically, it's something that not only happens with trading concepts from normal, in trading concepts, but also you see that back in normal life. When a river from the mountain is flowing to the sea, the river is going to choose the path of least resistance. It's not going to bump into the rock, stop there and wait for the rock to move aside. No, it's going to bounce off the rock and choose a new direction and follow its path. Price does the same. Price never stops. It always moves forward. Well, except Saturday and Sunday. So The river is the same. It flows and seeks the path of least resistance. Now, price, in my opinion, is the river. And if you look at how price moves, it sure looks like a river. Now, rivers sometimes crawl backwards, as we know, like this. Of course, price cannot go back in time, but you get my point. It looks a lot like a river. So that's how I see the path of least resistance. And obviously, lower time frames are going to have a bit of a bump. We're going to give a bit of a kind of like a resistance, right? But maybe just a small bounce and price continues. A big stone in the river is going to have a lot of influence, right? So therefore, also a big resistance in the market is going to have a big influence. Not all objects will block the river in the same way, and not even all objects will block the river. Sometimes the river power is so strong that it's going to actually set aside the object or the resistance. That happens with price too, doesn't it? When you have a big momentum and you have a medium resistance, the momentum or the speed of the river can break through that resistance, and it's not there. All right, so that's always the question. And you can see that from the river example why impulse trend versus support and resistance is so important in trading. Same thing in real life. How about swimming against the current in the river? Let's say you're swimming against the current. What's easier, to swim with it or against it? With it, right? With it is a lot easier. So whatever time frame you look at, swimming with the river is easier, which means swimming with the impulse is easier. When the impulse happens, they can happen in all kind of conditions. But it's easier for beginning traders to spot them, at least in the when there's a trend. More experienced traders are able to spot maybe potential impulses when there's a reversal range. But no matter the environment here in this case, there's always impulses and corrections. And they happen at various times. But what we find out with this particular real-life example is that swimming with the impulse, basically, swimming with the river, a current, is easier. What else can we learn from real life? Hiding below umbrella is a lot more vulnerable than hiding in a house. It's kind of logical, but what I mean with that is that if you're trading, basically hiding a stop loss or taking a trade close to a bigger support or resistance is going to have more value, of course, than a minor level. And just like we have ceiling and floors in the house, we have the same in our Forex house. And that's, again, support and resistance. So basically, the last two examples were regarding support and resistance. And this was more like flow, trend, and impulse. To decipher and understand the path of least resistance. Now, there's also divergence, which I really didn't have divergence to understand when the trend and impulse could be over and the support and resistance has more chance of winning. But I didn't know really how to make a translation of normal life of divergence. Couldn't think of it. If you do, by all means, write it down. It will be interesting. If you think of something, let me know. So what's the flow here when you look at the moving averages? And we start to move down and like this and move down again. What's the flow? Down, isn't it? We don't know about support and resistance, but what's the flow here? Prices above moving averages, they're aligned up. So in my opinion, what I do to understand what the structure is and to understand what the path of least resistance could be, I use these tools to determine that. Tops and bottoms, highs, lows, fractals, Fibonacci retracements and targets, moving averages, awesome oscillator and divergence, trend lines and channels, trend channels, and the Kimmerola. Everyone's going to have their own tool set, but this is my, how do you say it, combination, or my, yeah. All right. So if you have any questions, let me know. Does it make sense? Anything you want to ask? Anything you want to add? We got a couple of minutes left, so we're earlier finished than normal. This is an example of dollar CAD 1 hour, as we said. All right, flow was down, but then we found the support. Boom, impulse up. Chart pattern. Boom, impulse up. Resistance. Boom, down. At certain levels, supportive resistances are going to have more probability than others. It's all about probabilities. It's not about being right or wrong. It's about probabilities. And those probabilities change. I mean, okay, this is a potential support level because it was a 50 fib. But the 50 fib could have seen also some small upside like this. If we see that, then you might want to move it to break even, because what does that say to us? That information is providing us that price action is communicating some message to us that we could maybe continue lower, and that we did bounce off the 50 fib. We use it as support, but the support wasn't too big, and we could see follow through to the downside. That's what it's telling us. That's the message. So yes, there was a very good probability of a bounce here. But then it depends, do we get a strong bounce or a weak bounce? We don't know that when price is not bouncing there as yet, or about to bounce. We don't know. So we can't say anything about that. All we can say that that's a decent bouncing spot, and then we'll need to see how it responds to that level. Then after we get that information, we can say more about the next step. So at this point in time, what can we say about the path of least resistance? We can say, well, there's a decent chance for price to go to the 50 fib, and that we're going to bounce there. After that, we are less certain. If it's a strong bounce like this, then it'll probably see some chart pattern for more confirmation, for more continuation. If it's a weak bounce like this, well, then there's probably more breakdown to the 61.8 likely. So we're pretty sure about the first two steps, but then after that, we branch out to two directions, right? But the first two steps, this is point 0 here, the first two steps we're pretty sure. It's bearish, then bullish. But after that, there's a split. Depending on how bullish it is, we're expecting bullish, bearish, bullish. Or we're expecting bearish. Yeah, and then maybe another split, right? Because then we're at the 61.8, so it could be bullish again, or maybe some continuation of the bearishness, for instance. So we have another split of the decision-making tree here, the probability tree, if you like, the path of least resistance. This particular style is mostly useful for discretionary trading, but it doesn't have to be. You could also use it for automated, in a sense that you could, for instance, have strategies that say, automated strategies say that at point X, I will change the strategy into that, for instance, right? Your configuration could be in your automated could be Y, W, Z. But if we reach point A, you would change it in Y, W, X. And the A could depend on a certain point of path of least resistance, for instance. So does that make sense, what Tarantula and I said, not only myself, but Any particular thing you found interesting about Nenet's part or myself that you thought, well, wow, that was actually something that didn't realize that was the most. Is there a brave person in this room that's going to speak out? Let's see. In any case, we do thank you for you being here in any case, and we thank you for your attention. We have next week again the live webinars, of course. Yeah, I love you too. Have a great weekend, everyone, in fact, and you too, Lau. And glad that you enjoyed the topic. Live webinars next week, Learning Lab, same time. No, that's Learning Lab. Actually, sorry, it's Monday, Wednesday, but we have our Pro Lab on Thursday, of course, same time, same place. No, it's Tuesday. Sorry, it's Tuesday, actually. We don't have Thursday webinar. We have actually what we usually have on Thursday is now on Tuesday. All right. Otherwise, everything is the same next week. Monday, Wednesday, Talantala is going to have his usual webinars. Tuesday, Wednesday, Thursday, I'm going to have my usual Trading Lab webinars. But the Thursday webinar is on Tuesday. Well, then in that case, I wish everyone, again, a great weekend. And above all, great trading, many pips, and great days ahead. Cheers.
Yeah, cheers, guys. Talk to you very, very soon. Cheers.